Hello everyone, welcome to the PCP Long Volatility Fund update call. In today's call, we will start with an update on the firm, the strategy and the fund. Then we will provide you the performance review of the fund, especially for 2023. And we will finish with a portfolio update and the outlook of the strategy. We will present you some slides. In case you are interested in receiving those slides, please reach out to one of our relationship managers. So let's start with a brief firm update. The asset under management of the firm are stable with 720 million across two business lines. The liquid alternative AUMs without the tulip funds increased to 410 million in 2023. The net inflows were driven by the PCP Long Volatility Fund as well as the PCP Tactical Macro Funds. Both funds had net inflows of around 9 million. We are currently 16 employees. We added one specialist on the IT side in 2023. From the 16 employees, 7 have an investment role and 9 have a business, respectively, an operational role. Strategy AUM of the long volatility is currently 220 million. That includes all investments PCP has currently to long volatility managers across all portfolios. The fund AUM as of January 1st, 2024 is 58 million, and we saw steady inflows each month in the second half of 2023 from existing as well as from new investors. That indicates investors were using the low volatility levels to take positions in the strategy. Further, there were some minor outflows of around 300,000. For those who are not familiar with the fund and the strategy, we provide a quick summary. So what's the opportunity set for long volatility strategies and especially our fund? We have again very low levels of volatility across markets and asset classes, and that provides very attractive entry points for investors. And of course, and that's very important, in case of a crisis, the strategy should provide meaningful upside, speaking of 70 to 80% in a 2008-like scenario, and therefore help investors to protect their portfolios. Implementation is key because otherwise long volatility strategies can become very expensive. That means we implement the portfolio in a carry neutral way, and as such, the portfolio is much less timing sensitive for investors. Also important, the strategy is diversified across many asset classes, regions, strikes, and maturities, as well as implied and realized volatilities, and therefore should be invested in those areas where we will see the largest asymmetries in a crisis scenario. The portfolio is currently invested in 11 long volatility sub-strategies, and all those sub-strategies show positive convexity and significant negative down correlation to equities. As a side note, from those 11 sub-strategies, only one is part of the CBOE Eureka Hedge Long Volatility Index. That's the most common used long volatility index consisting of long volatility funds. When we construct the long volatility portfolio, we aim to be a better form of a put option, and for the past 2 years, we were able to deliver on that goal. So what does better mean? We want to provide a much broader protection than a put option. That means we are diversified across asset classes and protect versus a broader range of risks. Also, we aim to provide a positive return over the cycle instead of the cost the put option has. We try to achieve this by an active value approach and by only taking volatility positions that are carry neutral. I have to stress the carry neutrality doesn't mean the portfolio will not give back in case of a broad decrease of volatility levels, but the portfolio does not have the time value costs of a typical put option. Implications are that the portfolio is much less timing sensitive for investors compared to instruments with higher carry costs. That means the protection allows investors to have higher allocations to equities and also to have dry powder and rebalance in case there's a crisis scenario. When we compare the return of the PCP long volatility fund to a S&P 500 put option, we see that since launch of the fund in January 2022, the fund generated a positive return of 7.4%, whereas an S&P 500 put option lost minus 6.6% during the same period. As the long volatility fund showed to be more reliable, also the long volatility fund showed to be more reliable than an S&P 500 put option. For example, in 2022, which was a very untypical crisis, that means we didn't really see an equity volatility spike, the PCP long volatility fund generated a return of 17.1%, whereas the S&P 500 put option was even slightly negative. When we look a bit more granular into the numbers, we have the chart on the right, which shows quarterly returns of the long volatility fund and a S&P 500 put option sorted by the returns of the MSCI World. We see that during quarters where the MSCI had a negative performance, the average return of the long volatility fund was plus 9.4% versus plus 3.9% for the put option. During the positive quarters of the MSCI, the fund was down only minus 1.2% versus minus 2.7% for the put option. So let's move to the performance review. 2023 was a difficult year with many headwinds for long volatility strategies. Volatility levels across asset classes were down significantly, and in the table we see that volatilities were down between minus 5 and minus 70%, with equity volatilities suffering the most, between minus 35% and minus 70%. The fund was down minus 8.3% in 2023 compared to the MSCI World Index, which was up 23.8%. That means in 2023, the fund lost around 30% of what the MSCI gained. When we compare that with 2022, where the fund gained almost 100% of the MSCI loss. In numbers, the MSCI lost around minus 18% and the fund gained plus 17%. That means in the last 2 years, the fund had an upside-downside ratio to the MSCI World of around 3:1. Since inception of the fund is still up 7.4%, and that despite equity volatility levels being sharply lower since the launch of the fund. I will now give over to my colleague Daniel, who will go deeper into the performance drivers of 2023.
Yeah, thank you very much, Daniel. As you just mentioned, I mean, 2023 turned out to be a very tough year for long volatility strategies in general, as there essentially was no place to hide, given that all major volatilities were down last year. That included US equity volatilities, European equity volatility, as well as interest rate volatility and currency volatilities. In terms of performance attribution in 2023, the portfolio suffered broadly from a very bullish asset markets and accordingly sharply lower volatilities across asset classes and regions. Specifically for the fund, the following were the main detractors in 2023. First, credit tail protection, which cost around 2.2%, and suffered mainly from narrowing overall credit spreads as well as narrowing quality spreads, meaning the spreads between economically sensitive credit have outperformed the more defensive credits in 2023. The second loss driver were realized volatilities across equities and inflation mostly, paired with a short equity bias. So those strategies cost about 2% in 2023 due to suffering from being short equity delta, long gamma, as well as from various factor headwinds within equity sectors. Another loss driver were correlation-sensitive cross-asset volatility strategies, minus or detracting 1.2%. Those suffered from the broad pressure on volatilities, as well as the broadly correlated bullish environment last year for essentially all financial assets. Last but not least, systematic realized volatility strategies, which detracted around 1%, suffered from a broadly decreasing level of realized volatilities, as well as low levels of the same across all major asset classes again. Now, was 2023 out of order? One possibility is to compare 2023 to 2019. Why can this comparison make sense? Because if we average the different volatility markets across asset classes, 2023 seems to be fairly comparable to what happened in 2019, as the average volatility markets in 2023 were down just shy of 24% across asset classes, and in 2019 they were down close to 22%, again across asset classes. Now, looking at the fund returns, as mentioned, the fund was down 8.3% net in 2023. This compares to minus 6.8% of the carve-out portfolio strategy return back in 2019. So comparing those fund and strategy return numbers to the market volatility return numbers, the 2 years seem fairly comparable on a high level. And by that means the 2023 result does not seem to be out of order when compared to the pre-launch strategy carve-out returns of the same portfolio and strategy. Another look at 2023 returns is when dissecting the underlying fund returns. And one of the key observations we had there is that 2023 turned out to be a very weak year for otherwise strong funds. What we see here is on the chart below is that 6 out of 11 funds and the 2023 simultaneously at the very individual bottom of their respective annual return histories, in some cases going back to 2017. And then also we saw similar characteristics in terms of those fund return distributions when we compare 2023 to 2017. Remember, 2017 was the 100-year low in S&P 500 realized volatility, so quite a standout year in the negative sense for equity volatilities. And again, it also seems comparable to 2019, where we see again very low individual fund returns, high equity returns, which is the red bar here, similar to 2017, and again similar to 2023. And we see essentially the lack of any positive, really meaningful positive outliers, both in 2023, 2019, as well as 2017. Now, what might make 2023 different? 2023 was unusual, one might say even highly unusual, in the context of the post-2020 regime of generally increased volatilities as realized volatilities as well, increased tensions, and generally higher inflation levels when compared to the pre-2020 financial regime. So that makes 2023 somewhat surprising. However, when looking back at 2017 and 2019, we see that every once in a while those years happen. Even though I mentioned the 100-year low in the realized equity vol in 2017, they should not happen all too often. Now, just a very quick view at performance since launch again. So as mentioned, the fund is up 7.4% net in the class I USD since launching in 27, whilst in 2022, January 2022, whilst equities are also up small 1% for the MSCI World. This significantly beats the index as well as mechanic forms of long volatility. For instance, since January 2022, the S&P 500 put option 1 month, 5% out of the money, is down 4.5%, and the more aggressive VIX futures medium-term ETF is even down a staggering 45%, mostly due to carry losses or negative carry as well. Then when the PCP Long Volatility Fund launched, the VIX level was at 17.2. In the past 2 years since launch, that level actually decreased from 17.2 to a mere 12.5, meaning that the VIX level alone decreased 28%. And this is completely excluding the strongly negative carry, which you essentially always incur if you were to mechanically buy, for instance, a VIX future. This means that since launch of the fund, there was a strong positive asymmetry versus equities, which was already mentioned by Daniel, resulting in about the 3-to-1 upside downside capture ratio. And what's interesting as well to see, or maybe comforting to see, is that diversification benefits since launch of the fund have really continued to be delivered. As a very simplistic example, when we combine equities in the form of the MSCI World with the PCP Long Volatility Fund in a 50-50 ratio with annual rebalancing, so just annual rebalancing, there have already been significant rebalancing gains when we look at those 2 years. In dark blue, you see the terminal value of the PCP Long Volatility Fund. In red, you see the MSCI World. And here in this bold line, you see the 50-50 combination with annual rebalancing, ending in a meaningfully higher terminal value than both of the individual assets, as well as, and what's even more, a significantly reduced drawdowns and downside volatility. So this is really the benefits of the negative correlation delivered by the PCP Long Volatility Fund to equities, as well as the rebalancing gains with the annual rebalancing in this case. Now a very quick look at the portfolio and outlook. So the current portfolio looks at this. It's the 11 funds as mentioned. And probably more important for investors, of course, the scenario returns, specifically the crisis scenario returns. Here we see again the 11 positions, which are currently part of the portfolio, and then the current scenario returns when stress testing the individual funds part of the portfolio to the specific historical scenarios. So one being the 2008, the 3 months, the height of the crisis in 2008, then the 2020 COVID sell-off, February, March that year, as well as the different slower moving 2022 sell-off spanning from January to September. And we see here that current scenario returns for the portfolio, net of all fees, bottom up look through would currently be 57% for the 08 scenario. However, just the 3 months there, so it's not the entire year. It would be 26.5% for the 2022 scenario and 22.7% for a repeat of the 2022 scenario. This is just to show that volatility levels are really low again. So in the upper two charts, you see some indicators and charts for equity volatility being really low again. And we also have some indications why that might be. So for instance, there is a staggering amount of upside volatility being sold in the market. Case in point here, an ETF where the AUM of this ETF have essentially ballooned in recent years. And what this ETF does is basically combining a long equity exposure with covered calls, meaning a long equity exposure with writing call options on the same equity index and equity exposures, leading to a substantial and here massively grown volume of sold call options, which can then be recycled by long volatility players to buy into cheap volatility. And as a side note here, even though this is upside volatility in the form of calls being written by these mechanic programs, this upside volatility actually, statistically speaking, turned out to be fairly interesting as a hedge, as even this upside vol is strongly negatively correlated to equity moves, meaning that it offers an interesting form of protection as well. A very quick outlook on volatilities. As mentioned, volatilities as well as various risk spreads, including in corporate credit, are very low and narrow again. And by that means, even just a mean reversion would now be interesting again, let alone a major crisis. So current levels are really low, especially in equity volatilities and FX volatilities, leading to a really positive asymmetry there in terms of reward to risk. And similarly in risk spreads, as mentioned, the cyclical credits versus the defensive credits have also gotten very narrow again suggesting that there is a major positive asymmetry to be had in that space currently. More specifically, in number terms, so for instance, the equity volatilities for S&P 500 and the Euro Stoxx 50 with maturities ranging from 6 months to 5 years are currently priced in the lowest 9 to 11% of their 20-year range. Similarly, in currency volatilities, for instance, the Euro USD implied volatilities are currently priced in the lowest 16% of the 20-year range. Some currency pairs, like for instance the US dollar CAD, is even priced in the lowest 3%. And as mentioned, the corporate credit spreads, the quality spreads are priced close to the lowest or tightest 10% of their long-term range. And in line with this, you see the VIX volatility levels. The recent one, which has gotten really low as of the end of the year and start of the year again, on the very long-term chart, for as long as the VIX index has been calculated, you see here that it's really on the lower end. It's not the all-time low, but really at the lower end of the long-term history, and clearly below the average level, and way below the occasional highs made during sell-off periods. This is just a slide to show that essentially the decade of 2010, which is the blue line here, the 60-40 portfolio performance during the 2010s, that's not at all the norm when looked back until the 1970s. So here on this chart, you see all these other decades going back to the 1970s, and then in red, the decade of the 2020s and how that started in terms of the 60-40 equity bond portfolio, the classic portfolio performance. And this is also what I think in the back, and we shy away from counting on a repeat on the 2010 decade, but are very open-minded to all kinds of other paths and scenarios for the ongoing 2020s decade. So this has been the update and review call for as of January 2024. We hope that it was useful, and we look forward to being in touch with you again very soon. Thank you very much for attention, and all the best.
Thank you.